Thank you. Good afternoon, everyone. Thanks for joining the conference call of Krishca Strapping Solutions Limited. I would like to welcome Mr. Bala Manikandan, Managing Director, Mr. Shivaji, Whole-Time Director, and Mr. Rajnikant, Independent Director of Krishca Strapping Solutions Limited. Bala sir, over to you.
Very good morning to everyone. I warmly welcome all of you to our first conference call following our listing at ASEMH platform. Today we gather to discuss Krishca Strapping Solutions Limited. It is a pleasure to have each and every one of you on this call. Before delivering into the financials, I would like to provide a brief overview of our company, Krishca Strapping Solutions Limited. Our company was founded on 2017 December as a startup with the primary objective to manufacture steel strapping, steel, and offer total packaging solutions to the steel industry. Within the
Yes, there is a slight disturbance on your line, sir, when you're speaking.
Is it clear now?
It is slightly better than what it was earlier, sir. If you're using the handset, it would be better, sir.
Okay. What about now?
This is much better.
Okay.
You may go ahead.
Okay. Within the last 5 years, our company has emerged as a leading supplier of strapping in the Indian steel industry. Our factory is situated in Chennai, Tamil Nadu, with an installed capacity of 1,800 metric tons per annum and steel capacity of 80 million seals per annum. This makes the largest steel strapping manufacturing unit in Tamil Nadu and one of the biggest steel strapping producer in India. Through our recent IPO, we successfully raised 17.93 crores. From this 17.93 crores, we are setting up a steel strapping line with a budget of 12 crores. And also we repaid certain secured borrowings of about 3.75 crores. This new production line will enable us to manufacture ultra-high tensile steel strapping with the annual installed capacity of 18,000 metric tons per annum. This expansion will double our current installed capacity and will contribute to our top line growth and profitability, while this repayment of loan will increase our balance sheet. In addition to expanding our production capacity, we are also venturing into the packing contract segment. This presents a very excellent business opportunity. The funds raised from our IPO will aid our entry into this packing contract segment. Our aim is to become a major player in the packing contract industry, catering to all the leading steel mills. So we intend to seize a significant market share in this domestic market and enhance our presence in the export market through increased capacity and packing contracts. Given that our business revolves around steel strapping, the growth of the steel industry plays a major role. If you look at India's current installed capacity, which is 120 million tons of steel per annum, so we are the second largest producer of steel globally currently. With the Indian government's efforts and of course the national steel policy, Indian steel industry aims to increase the installed capacity to 300 million tons by 2030. So this provides an excellent opportunity, and the market is also going to grow at a minimum 10% year on year for the next 10 years. So with the expansion, technology upgrades and new projects in the steel industry, provide an excellent platform for the supply of steel strapping and also the strapping machines and the automatic packaging line. At present, from our market estimates, we are roughly holding about 7 to 8% market share, while the leading player called Signor India, they are having about 49% market share. And the second biggest company is holding about 28% market share. And there is one more company that is the third biggest player. They are holding about roughly 10% market share. So with the increase in production capacity and also entry into packing contracts this year, we are expected to capture much more market share in the coming years. Now let us look at our strength that differentiate our company from other steel strapping manufacturers in India. If you look at the Indian steel strapping industry, Krishca Strapping is the only lead-free steel strapping producer. And also, our production is the only fully automated production line. From the start to end, it's a single production line which is fully automated. If you look at the competitor, all other people are doing a 2 or 3 step process. So this provides us the lowest production cost in the industry when compared with our competitors. And also our employee cost is the lowest in the industry. And our factory is located in Chennai port, which enables faster exports to all the destinations when compared with our competitors. And with this brief introduction about the company, now let's move on to discussing about our financial performance in the last financial year, FY23. I am very pleased to announce that our revenues have increased 4 times compared with financial year 22, and our net profit has increased almost 6 times when compared to the last financial year, 22. To summarize the financial highlights of FY23, total revenue was 72.4 crore in the last financial year, which is 386% growth when compared to FY22. And our current EBITDA is 13.87 crores, which is almost 330% growth compared with the previous year. Our current EBITDA margin is about 19.15%, which is almost 2% increase when compared against previous financial year. Our net profit for FY23 is 9.34 crores, which is a significant growth of 518%. So almost 5 times our net profit has increased when compared against FY22. Our current net profit margin is about 12.9% compared to 8% in the previous year. Our current earnings per share reached 10 rupees 68 paisa compared to 2 rupees 22 paisa in the previous financial year. So we maintain a highly optimistic outlook for the future demand and anticipate reporting robust numbers in the current year as well. So we are very much positive that this year, in this financial year, we will increase our revenue by at least 40%. And as I explained, we are putting up a new production line which can able to produce ultra-high tensile steel strapping. That is also an excellent opportunity to increase our sales. And as well, we are entering into packing contracts. So that is also providing an extra opportunity to increase our revenue. And apart from our efforts in domestic market, we are also setting up a new office in Dubai. By end of July, we will have an operational warehouse and office in Dubai. And already we have recruited a few people to join from 1st of August. So from our new office in Dubai, we are expecting to increase our revenue now not only by selling steel strapping. We are also trying to trade other items to provide a total packaging solutions to our customers. So with this, I will now hand over the call to the operator, and I'm happy to answer any of the questions you are having.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mayur Liman from Profitmart Securities. Please go ahead.
Thank you so much, and good afternoon all. Thank you for the opportunity, and congratulations on a good set of numbers. My first question is, I just want to understand, in FY20, top 10 customer contribution is around 95.06%. It has now reduced to around 68.73% for FY23. Could you please throw some light on that?
Yeah, sure. If you look at our FY20 figures, our revenue was about 9.8 crores in that year. We started our commercial production from the month of March 2020, and immediately upon our production, COVID lockdown was imposed. So in the first financial year, we were not able to cater the large volume customers like JSW and Tata Steel because we never completed our vendor registration in the first year. So we were mainly supplying to the local Tamil Nadu players. During COVID, we were unable to travel also. So our customers were very limited. So that's why we hardly had 20 customers in the first year. Maybe that's the reason revenue from top 10 customers is looking very huge. But now in the last 2 years, we added so many new customers like JSW Steel. We just added 2 years back, and POSCO, and there are some packing contractors. They are taking almost 2 to 3 crore worth of material from us. So all those new customers we added in the recent years, and also we added so many small customers also. That's why the total revenue from the top 10 customers are keep decreasing. It will keep decreasing up to, because we need more customer base. That is good for us. We have to diversify. We cannot depend on large volume buyers. That is always a risk. Even if one customer leaves from our, they will take a significant amount of revenue. We will try to add more customers with the small volumes in the future.
Okay. And my next question is, what kind of initiative the company is taking for the export sale?
Sorry, can you repeat the question again?
Yes. What kind of initiatives the company is taking for the export sales, international sales?
Yeah. So right now, we are in the process of setting up a company in Dubai. The registration process is going on. By mid of July, our company, which is a subsidiary of Krishca Strapping, will be ready in Dubai. And we already recruited 2 people to join from our Dubai office. So they will stay in Dubai. They will cater the entire Middle East market. Because Middle East, there is not even a single straight strapping manufacturer in the entire Gulf Middle East region. So that's where we want to, explore initially. And we look at most of our export sales is going to Middle East only. So by having local presence, we strongly believe that we can increase our export share up to 30%. If you look at current export share in our revenue, it is almost only 10-15%. So in this financial year, I want to increase the export sales to at least minimum 24-30%. And the major goal of setting up an office in Dubai is eventually after 2 years or 1.5 years, we will have to come up with a production line in Middle East.
Okay. Thank you, sir. And my last question is, now the company revenue went up around 290% and the PAT is up around 500%. What is your expectation from the next financial year and what is the outlook for the market for the next financial year?
Yeah, if we look at this financial year, 23-24, we are very much optimistic that we will deliver a revenue increase of 35 to 45%.
Okay, and how do you see the market for the next year?
Next year would be much better than this financial year. The reason is we are putting so much effort, in packing contracts, and we are appointing a head of packing contract division from August 1st. So right now, there is no packing contract team, and by 3 months there will be a bigger team in our place. And we are coming up with a new strapping line, which is expected to be operational by December month this year. And as I said, we are setting up a new office in Dubai. So all these 3 efforts we are putting in this financial year, we will bring much more, revenue in the next financial year. So compared to this financial year, I'm very much optimistic about the next financial year.
Okay. Thank you so much, sir. That's all from my side, and best of the luck, sir.
Thank you very much.
Thank you. We have the next question from the line of Harsh Mulchandani from Chris Portfolio. Please go ahead.
Hi, congratulations on a set of good numbers. Wanted to understand the economics for the packing segment, which is where you are going to enter packing contract segment. How does that work, and is it going to be different from the existing strapping business in terms of revenue potential, margins, etc.?
Yeah. Hi, Harsh. Good morning. So if you look at the packing contract industry, it is mainly, dominated by the steel strapping manufacturers like my competitors, Ignore. They are the major packing contract in India. Because steel strapping is the major packing consumable in the packing contract for steel industry. So since we already have steel strapping, and also we are very comfortable in supplying strapping tools. To do a packing contract, let's say a TMT bar is being produced in a steel mill, they will need a strapping tool and also steel strapping to do the packing and the manpower to do the packing. So out of three elements, we have the steel strapping and the strapping tools. We only need to deploy manpower in the site to do the packing. So we are very much positive, but this will bring much more revenue because number of manpower will be very high because we are running a 3 shift in that steel mills. So we will generate much more revenue by supplying the manpower also, and also we will be responsible for the maintenance of tools and providing spares, everything. The reason for entering into packing contract is that it provides a very stable order. Each packing contract, it is minimum 1 year, even up to 5 years. So once I get a packing contract, my steel strapping sales is assured for minimum 1 year at a agreed price. So I don't have to negotiate each and every month for the consumable supplies. So this gives us a assured revenue. That's why we are entering the packing contract.
Okay, got it. So typically it's more of providing manpower over there and a lot of visibility once you get the contract. That understanding is correct, right?
Yeah, correct. It is 60% is strapping, maybe 40% put together steel strapping tools and the manpower will come. So anyway, we are already doing 60% supplies. We only need to have the remaining 40% elements, which we are very much comfortable doing.
Got it. Perfect. Thank you.
Yeah, thank you, Harsh.
Thank you. The next question is from the line of Naveen from Bellwether Capital. Please go ahead.
Yeah, thank you for the opportunity. Am I audible?
You are audible, sir. You may go ahead.
Yeah. I want to understand about the industry in terms of what are the entry barriers for a new player to get into the industry. How difficult is it?
The major entry barrier in this industry is getting your product approved at all steel mills. It took us almost 3 years to get our product approved because steel strapping is a very safety critical item. The items packed using steel strapping are weighing between 10 to 25 tons. You look at the HR coil and CR coil from steel mills, minimum 10 tons is the weight. Even if there is any small crack in the strap, it will break. It will lead into very severe accidents or fatality. So steel mills, they give utmost importance to steel strapping purchase. So getting a product approved will take minimum between 6 months to 12 months. And if you look at the public sector, like SAIL and Vizag Steel, all those steel companies, that is even more difficult. Because they will ask us to provide a PO from private mills for at least 10-15 crore worth purchase orders in the last 2 years. So even to participate in the PSU, we need at least 3-4 years of experience, market presence, so that we can even participate in the PSU tenders. If you look at our company, till now we are only supplying to the private companies. We haven't entered into the PSU. For the first time, we are participating in a PSU tender in August. Now only we got all the credentials to participate in the tender itself. So any new player will have to go through this approval process and supplies previous year supplier criteria. So it is a slow process, I would say.
And is it a contract, long-term contract, or every year based on the pricing it gets renewed?
If we look at our current order book, about 40% are long-term contracts from various mills. JSW Steel, we have a long-term contract of a year. And the POSCO, which is a Korean company, we are supplying to the entire 6 service centers in India. There we have a 6-month contract. And there are packing contractors with whom we have 1 or 2 year contract. So remaining 50% of our sales will go to multiple people. There the contract, if they, whenever they have requirement, we give the pricing, we'll get the order. It's like that.
Understood. Is there any alternate material which can do the same work instead of steel strapping? Is there anything else in the market?
See, the industry we are catering is steel mills, mainly JSW Steel, Tata Steel, all those bigger steel mills. There, the steel is produced at a very high temperature. Okay, our steel straps are, being used to pack when the steel coil comes out of the oven, which is almost 200-300 degrees. There is no other consumer which can withstand this temperature during packing. There are, if you look at the secondary market, pet strapping is used heavily, but that can used only for very stable loads, up to 500 kg, 1 ton. But in the steel industry, we are not looking any alternate materials in the near future.
And why don't the steel mills themselves produce this material?
It is a very interesting question. If you look at JSW Steel, they have about 11 to 12 different production sites in India. From South India till they have Kolkata, almost 11, 12 sites. And each and every site has a different packaging requirement. So the size of steel strapping, if you look at the thickness ranges from 0.4 mm to 1.27 mm. And there are 5 different width combinations. Okay, so almost 30 to 40 different types of strapping is being used at various locations. So if you look at the JSW Steel, they are they are doing almost 2 lakh crore revenue. Okay, they cannot cater all these small requirements. Each site will use 10 ton, 20 tons, and different paint, different packing. So it is so many combinations. A company like JSW Steel, when I think, they will think minimum 10 crore budget, they will think about it. So for a mere cost saving, they cannot do this kind of thing. That is my opinion, because I am also buying cardboard boxes and other things consumable for my factory for up to, let's say, 20 lakhs per month. Okay, for that I cannot go on put a cardboard manufacturing or other HTP production line. That is not viable. No, my major aim is steel strapping production. So I think the steel mills also will look at this in that way.
Understood. My last question is, you had touched about your margins compared to your peers. If I look at your peers, margins is in single digit, EBITDA margins I'm referring to, but yours is in 19 to 20%. You touched about automation. Is there anything more, if you can add more color, that will be helpful? Because if I look at your one of the highest margins in the industry.
That's because we have the automatic production line. Our production cost is less than 50% of my competitors, and we are using different grades of steel. Our production line is designed to process multiple grades of steel as a raw material, because we are using induction oven, which can tune the temperature very easily, between 300 to 700 degrees. So what happened during COVID, there was some orders. We focused on R&D, and we developed various alternate grades which are cheaper to the traditional grades used by my competitors. So even in the raw material, we are saving about 5 to 6% compared with the competitors. And our production cost also much lower, and our employee cost is much lower. So putting together all these things, we are able to get a better profit margin.
And is this margin sustainable?
Yes, very much sustainable, because after IPO, our debt level also reduced, and we are increasing the revenue. We are not increasing the manpower to the same level. No, already we have the sufficient team in place to do the one more production line. So definitely these margins will be in the same level, between 11 to 14% in the near future.
Understood. I have a few more questions. I'll get back in the queue. Thank you for answering all my questions.
Yeah, thank you, Konawai.
Thank you. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Hello.
Yes, we're audible, sir. You may proceed with your question.
Okay. Yeah. Thank you very much, sir, for the opportunity. So I just wanted to know, in your releases you mentioned that in this FY23, our capacity utilization was close to 37%, right? So as per current capacity, our revenue potential is close to 200 crores. Would that be a fair understanding?
I think there is a mistake. Our current capacity is about 55% utilization, not 37.
But it's mentioned in your press release, 37%,
Okay, I will check it. See, currently we are at 55% capacity utilization. So with the similar current line, we can do up to 140 crores, 150 crores.
Okay, understood. Fair enough, I understand. And with this new capacity that is coming, our revenue potential will be doubling to about 250 to 260 crores, right?
Yeah, because the new line has the same capacity. We are doubling the capacity. So upon completion of this new line, we'll be our 300 to 350 crores we can do from the installed capacity.
From 300 to 350 crores.
Yeah. From the installed capacity from December, we can do up to 350 crores. 350
crores. And our installed capacity post this expansion would be 36,000 metric ton per annum for steel straps?
Yes, correct, sir.
And what about what about strapping seals?
No, strapping seals, we are already increasing the capacity by 30% investment. So we can do up to 120 million tons of seals.
So from 80 to 120, right?
Yeah.
Okay, and that also coming by December 2023?
No, that will happen next month itself. It's a small investment. We're just adding a few presses. We are just investing 10 lakhs to increase the capacity.
Okay, understood. And in the previous participant, you mentioned about 11 to 14% margin, right? That's the range. That's the PAT margin we are talking about, right?
Correct.
11 to 14% range. Okay. So even when you get leverage, I mean, this 260 crores or 300 to 350 crores revenue potential, that's the range we would be looking at?
It's the minimum range we will deliver. But going forward, definitely that will increase.
Okay.
But it will not go less than 1% at any point of time.
Correct. Understood. And by when we are targeting to kind of achieve our full utilization, I mean, that 300 to 350 crores, I mean, in next 2 to 3 years, or how would the timeline look like?
See, we are, assuring a minimum revenue increase of about 6% year-on-year next 5 years.
So your voice was cracking, sir, so we could not listen to you.
Can you hear me now?
Yes.
We are, definitely assuring a minimum increase in revenue of 40% year-on-year for the next 5 years.
Next 5 years?
Definitely, yeah. Within 5 years, definitely we will use the full capacity.
Understood. Okay, that's it from my side, sir. All the very best. Thank you.
Yeah. Thank you, Mr. Deepak.
Thank you. We have the next question from the line of Hiral Nandu from Kalpavruksha Capital. Please go ahead.
Hello. Thank you for the opportunity. Hello, Mr. Bala. Just couple of questions. One is on the IPO fund deployment. Have it gone already deployed, or it is still in unutilized some amount? Secondly, the packaging service, what we are talking about, what will be the margin profile in that? Will be a better margin compared to the steel scrap and sale of this, or it will be a similar margin? And what turnover we expect from this packaging service, maybe over a year or two timeline?
Yeah, thank you for the question, Hiral. Regarding the IPO funds, we have already pre-closed the unsecured loans of 3.75 crores immediately upon receiving the fund.
Okay.
And we have given advance to the suppliers of the new production line. Some advance has been given already, and some minor components we are finalizing. So I can say roughly 40 to 50% funds already been deployed.
Okay, great.
And when we look at the packing contract margin, the margins are currently in a similar level.
Okay.
There will be up to 15% margins are there. But the thing is, it will bring us much more revenue than what they are doing, because in the packing contract, only 60% to 50% is the strapping component. So we can able to fetch much more revenue and also profit. We are doing service like manpower and strapping tools maintenance.
So we will be giving them a end-to-end solution kind of a service.
solution for the packing of the particular product.
So which will help us to gain more customer and more bigger contracts.
Yeah, stable revenue and better. How can say better, more revenue because of we are adding manpower and other things into the thing. Stable orders for scrapping also.
Okay, great. And if we have to bifurcate in a percentage term that in a particular year for turnover, say by 24 or 25, how much percentage would be towards packaging and how much would be towards stripping sale?
In this financial year only, we are starting to participate in all tenders, and each packing contract has a eligibility criteria. So to crack first 3 or 4 contracts, it will take some time. But once we have the experience and the purchase orders from the 3 or 4 contracts, we can able to participate in much bigger contracts.
Okay.
So moving forward, let's say in the long run, in 3 to 4 years, we are aiming to get at least 30% of our revenue from packing contracts.
Okay, great. And with the current expanded capacity, future expanded capacity, we are targeting for a turnover of 300 to 350 crore per annum, right?
Yeah, with the installed capacity, we can do up to 350 crores, certainly.
Okay. Great. Thank you for this reply.
Thank you, Mr. Hiral.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. We also request that you limit your questions to 2 per participant. For follow-up questions, you may rejoin the question queue. The next question is from the line of Namish Gupta, an individual investor. Please go ahead.
Hello?
You are audible, sir. You may proceed with your question.
Okay. Sir, congratulations for the good set of results. Sir, I have 2 questions initially, sir. My first question is, sir, if we see your results, you have grown multifold from 18 crores to 72 crores in just 1 year period of time. So I just want to know, sir, there are so many players in the market. So what has been the differentiating factor that we were able to capture such good market share from already big established players?
Okay. Mr. Namesh Gupta, before we entered the market, if you look at Indian staffing industry, there were only 3 players in the market. In the last 20 years, there are only 3 players. The biggest player is called Signode. They are a US company. And the second biggest player is called Grip. They are a German company. And there is one more player in Kolkata. They are very small in terms of revenue compared with the first 2 players. So, market is desperately looking for additional alternate suppliers. Whenever I go to a customer place to supply steel strapping, we got a very good reception. Because in the past 10 years, they've been buying from a same source. Any good purchase per guy will always try to, encourage more vendors. And that too in steel strapping, margins are good compared to other steel products. And when we compete against a US company and German company, our overheads are much lower. And our production cost and employee cost, which is very cheap compared to the other players. So we got a entry at all places easily because of our much more competitive pricing.
Okay, so that means, sir, is the entry in this field is relatively easy since some more other players might be looking at the margins of your company, they might be interested to enter this field.
Market is big. If you look at the steel industry in India, it is currently 120 million tons. Almost all the major steel mills are under expansion. So market is going to increase, 2 times, 3 times in the next 10, 15 years. So even if the new player comes also, there is space in the market.
Okay. Sir, may I ask one more question? Just related to some cash flow.
Yeah.
Okay.
Sure, sir.
Sir, so in your profit and loss account, sir, you have shown a tax amount of around 2.93 crores.
Okay.
But in your cash flow, you have shown a tax of 2.99 crore. But in your cash flow, what I can see, you have paid the tax of only 82 lakhs. I'm not able to get this, sir. I mean, since when you show like whatever amount you show in your profit and loss account as a tax, normally that much or like 80 to 90% amount is normally paid. I mean, since through like advance tax or TDS, like something, but in your cash flow amount is very less. I mean, if someone can answer from your team, sir.
We have paid the amount. Yeah, please, sir.
Yeah. See, I just want to make a clarity over here. We have paid an advance tax and TDS to an extent of what was mentioned in the cash flow. But however, we are planning to remit the balance tax before end of this month. And rest we can file maybe a little bit amount, whatever interest is coming, we can pay and file the returns.
Okay, so we will pay the balance amount along with interest.
Yeah. Since it's a company incorporated maybe 3 years before, and company wants a working capital, so we just flow back this money. Otherwise, we don't have any intention not to pay the tax. But however, since we have been coming with a cash flow, and even this first quarter result is much better in terms of net accruals, with that we are trying to clear the tax, and whatever leftover is there, which we can pay by the time of filing the IT returns. Anyhow, we have a due date till 30th September.
But sir, till 30th September, there will be huge interest and other components on the original.
Majority we are going to clear before end of this month.
Okay.
Maybe anything left over like 5-10 lakhs, which we will pay and file the return. That's our plan based on the cash flow.
Sure. Thanks, sir. Thanks for answering my question.
Yeah.
Thank you. We have the next question from the line of Viraj Mahadevia, an individual investor. Please go ahead.
Hello, sir. Congratulations on making headway into what seems like a very interesting industry. I'm very new to it. You've touched upon what gives you your competitive advantage. How much is the pricing differential between yours versus the incumbent MNC players?
Hi, Mr. Viraj. See, it is case to case they are supplying. If you look at the PSU, currently I haven't entered. So there the margins are very high. They only enjoying that. At an average, I can say it is about 5 to 6%.
5 to 6% discount. And that's sustainable because of your automation, because of your lower labor cost. And was there a third thing also responsible?
Production cost.
Lower production cost. But production cost is lower because of your automation and lower labor, right? Anything else?
No. We are using induction-based furnace, and competitors are using muscle-based furnace. So the energy cost, which is almost 50% of my competitors. So let's say I'm only doing 2,000 rupees per ton in energy cost. Other people are doing almost 4,000 rupees.
Fantastic. And this new capacity expansion where you're doubling your capacity to then eventually take it to 300-350 crore top line, how is that being funded? Yeah. Entirely through the IPO proceeds and cash accruals, or are you taking any debt?
No, it is entirely from the IPO proceeds.
You will continue to be near debt-free, basically.
Yes. We will continue to have only working capital limits.
Exactly. That's what I was going to say. So your only interest costs will be working capital related.
Correct.
And in your presentation, you mentioned opening up Dubai to access the U.S. market. I didn't quite understand that. Why do you need Dubai to access? Why can't you access straight from India?
It's an interesting question, Mr. Viraj. See, if I supply steel scrapping from India to U.S., in U.S. there is an anti-dumping duty of almost 50%. After Trump came, he improved the steel tax on India and China steel.
Right, and not there from Dubai.
Which is almost, for my HS code, is coming about 50%. So with the 50% anti-dumping duty, definitely I can able to sell any of steel scrapping in the U.S. But the reason of setting up a base in Middle East, I can buy cheaper material from anywhere in the world. I can buy raw material from Korea, China, wherever it is cheaper. and I can process it. I can export anywhere in the world without any anti-dumping duty.
So would Dubai be more of a trading arm, or would it just be a routing arm for your India manufacturing?
Right now it will be a trading arm. We cannot route the sales from Dubai to US. That is not legally correct. So we have to manufacture it in Dubai, then only we can able to sell to US.
Understood. This is why you're thinking of setting up a small manufacturing line in Dubai.
Yeah. So in the next 1 year, during trading, we will do a market research of where to set up a plant, which is more viable. So after that, we will definitely put up a plant over there.
Right. And that would also be funded through internal accruals?
Well, at that point of time, based on the budget after the project, we have to take a call.
Understood. Sir, can you throw some light on this China Plus One policy? Everyone in manufacturing talks about it. But are you really seeing export customers coming to you saying we want an alternative to China? Do you have someone focused on export sales? I see in 23 exports is about 8 crores for you. It can be 100 times that number eventually. So I'm just trying to understand, what is the level of depth or seriousness about this China Plus One sourcing? Is it coming as a pull factor from the end client, or are you having to proactively approach these export customers through your sales office?
See, from our export clients, even though they have a very, comfortable Chinese supplier, still everybody is adding an Indian supplier. At least they want to do a trial and demo completer so that they can place the order in the future whenever they want. So like that, we got many inquiries from Middle East.
So they're inbound inquiries. These are inbound inquiries.
Yeah. And everybody wants to diversify from Chinese supply. That is, even if the small percentage of the customers come to India, that's a very significant volume.
So this 8 crores represents really the trial volumes of these export customers, because, typically if they approve you as a credible supplier, these volumes can go up 5-10x very quickly.
Yeah. See, when you look at this 8 crores, there are customers who are giving out of 100% share. Some people are giving 20% share to me, even though Chinese is cheaper. They want to have an Indian supplier on month-to-month basis. And some people are giving 30%, 40% market share. So like that, we are getting more market share despite the higher pricing in Indian steel market due to this China Plus One policy.
Okay. Last 2 questions. Why is India pricing more expensive than China?
That is not in my hand, sir. If you look at currently, Indian steel pricing is at least $200 more than international Chinese.
Your raw material cost is higher.
Yeah, raw material cost is higher. The domestic steel pricing is $200 higher than the international pricing at the moment.
Right. Okay. I think that's all from my side. All the best.
Yeah. Thank you very much.
Thank you. We have the next question from the line of Janak Lotwala, an individual investor. Please go ahead.
Hi, sir. Thank you for taking my questions. I have 2 queries. First is around the 35-40% guidance that we have given for the current financial year in terms of top-line growth. So what are the key 2-3 risks that you foresee to achieving this, both in terms of top-line as well as in terms of bottom-line? Do let us know what are the potential headwinds or the risks that we can encounter on this journey, one. And the second query is around the Dubai expansion that we are doing in this call. So in this call, we mentioned that we are planning to expand our office out of Dubai to cater to the US and the Middle East market. So you mentioned that there is lack of competition to cater to Dubai as far as staffing solutions are concerned. So what are 2-3 reasons that is discouraging the existing players to cater to this market or establish the office out of there? What is discouraging people or the MNCs to cater to the Middle East market directly?
See, if we look at this market, in India, Signode is the number 1 player in terms of market share. Signode has a factory in Turkey, and Signode has a factory also in Korea. So for the Middle East market, they have internal agreement that it will be catered by Turkey Signode, not from Indian Signode, and also from Korean Signode. So naturally, when I compete against Turkey pricing, my pricing is much more attractive. So due to this thing, we are able to sell more volume in Middle East. That is one thing. And there is not much trade happening between Turkey and Saudi. So that is also an opportunity for Krishca to supply more material to Saudi from India.
Okay, got it. Fair enough. So, but why are Indian players not really being encouraged to take this route? Are there some other entry barriers for Indian players over there?
There is no entry barriers, but see, because Indian market, there are only two other suppliers. That's why there is very limited suppliers. And in India, one more company is a German company, and they have internal policy that some regions will be catered by the German European market. So we are free to supply anywhere, but other two competitors are limited in terms of their, due to the international presence from in Europe and Asia.
Okay, fair enough, sir. And the first query, as far as the guidance is concerned, what are the 2-3 possible risks that you foresee in both top line and bottom line growth that we just guided for FY24?
See, if we talk about the risk, some of the revenue we are expected to come from a new production line in the last quarter. So new production line will be operational by December as per our current planning. And January, February, March, I have taken some revenue from the new production line as well into consideration. So let's say, by any chance, if there's a delay in the commissioning of the new production line, that might affect the revenue by some level, maybe not much, 5-6%. And that is one risk. And, our revenue is based on the steel pricing. So now if you look at the past 2 months, there is a dip in the steel pricing in the month of April, also in the month of May. So if it continues to go down, our revenue will go down, obviously, because steel pricing is go down. But in terms of profit margin, our margins will be in a similar level, despite the steel pricing, because we operate based on fixed margin level. Whatever is the raw material pricing, the margin will be similar. So our revenue might get affected because of the volatility in steel pricing. And also, if there's a delay happen in the commissioning of any production line, there will be a 5-6% revenue dip might happen. These are the possible risk factors.
Okay, fair enough. And one follow-up to this. So, how susceptible do you see are we to raw material price fluctuations, or do we use hedging as a policy to protect against it? Do we have some mechanisms like this in place?
Yeah. See, we have a quarterly contract with some suppliers, and we have a 6-month contract with some suppliers. So, and also we have a monthly spot price suppliers. So we have different combination of suppliers. So even if there is a sudden price increase, let's say in July, August, I will mostly buy from my quarterly supplier or 6 months supplier. So they will keep the price the same for 3 months, 6 months period. So like that, by having multiple suppliers with different, pricing policies, we can able to protect ourselves.
Fair enough. So is it fair to assume that we are protected at least from price fluctuations for 3 to 6 month period? This is what we are trying to imply?
Correct.
Okay. Thank you for taking my query. That's it from my side, and wish you all the best for
Thank you very much.
Thank you. We have the next question from the line of Pawan R, an individual investor. Please go ahead.
Hello, sir. Thank you for this opportunity. Am I audible?
Yeah, yes, Mr. Pawan. Please go on.
Yes, sir. I was highly impressed with this promoter, sir, Bala Manikandan, sir, because of his past achievements, what he has done. So what I saw is he's an expert in cyber security, private security, and IT firms. So is there any chance in future that Krishca may venture into those fields also, like after 5 years or 10 years, like that?
First of all, thank you, Mr. Pawan. I don't think I will venture into cybersecurity because in cybersecurity, somebody should stay relevant. It's a fastly evolving industry. Even if the past 5 years, I'm not at all into that industry. So whatever I know must have been changed now. So and since I am fully committed with Krishca, I have no plans to go into that sector at all.
Okay, sir. No issues. Thank you.
Thank you. The next question is from the line of Anand Patel, an individual investor. Please go ahead.
Yeah, good afternoon all. So from our presentation, it is like Indian steel strap industry is, I think, around 10,000 to 11,000 ton per month. So how much is
correct.
Correct. So how much is the import out of that, and any anti-dumping duty from Indian government which is helping the domestic players?
Yeah, there is anti-dumping duty for steel strapping, and also there is one more thing called BIS. There is a BIS certification required for any steel strapping manufacturer to supply to India. If you look at the overseas suppliers, there is only one company in the world has BIS out of India. So only that company can able to supply to India, which is a Korean company. If you look at the total Indian market, only 1 to 2% are imports.
Okay.
And that also pricing is higher than the domestic market.
Okay. So for similar grade of steel strap, what is the price difference between our company and China? I mean, even if China is cheap, they cannot supply. Am I correct?
Yeah, there is one thing. They should have BIS. Currently, no, none of the Chinese mills are having BIS. Let's say somebody go ahead and get a BIS, and they have to face import duty, which is a 7.5%, and there is anti-dumping duty also. I think for steel strapping grade, almost 10%. So roughly 18% additional tax somebody has to pay in order to supply to India. And the current price difference between Chinese and Indian pricing is about 20%. So even if somebody put an effort to import that, it will be on par with domestic pricing. So without any pricing advantage, they cannot do much volume.
Okay. Understood. And raw material constitutes a significant cost of production for us, around 70 to 75%. So how fast can we pass on incremental raw material costs, if any? I mean, like price revision with our customer happens every 30 days, 90 days, even if contract is for 5 years.
We usually pass on the price increase by monthly. Whatever the price increase in June, let's say 3 rupees or 4 rupees, that will be passed on in the July pricing. And there are some contracts which involves a quarterly price increase. In some cases, there we are passing on the price increase on quarterly basis.
Okay. Thank you. That's all from my side.
Yeah. Thank you, sir.
Thank you. The next question is from the line of Manan Patel from 3P Capital. Please go ahead.
Hello. Am I audible?
Yes, you are audible, sir.
First of all, congrats on successful IPO and Q4 results. Most of my questions related to metrics have been answered. I'm just left with a couple of questions. My first question is, you are part of 2 other companies, Maxwell Business Services and Biomax India Private Limited. Are there any future plans to start a different kind of business or to integrate these 2 companies into Krishca?
Maxwell, that company I just started along with a friend to supply manpower. My friend started, I just invested, but it didn't take off. So that company is in the process of take off. So it will be closed maybe within this financial year. We didn't do any operations in the company. Okay. And in Biomax, I'm not a director. My wife, Sarladevi, is a director. That is a small trading arm because my native is Vagati. So we are doing some trading of pyros consumable in that company. So there is no relation between Krishca and Biomax. That will be a separate entity.
Got it. My second question, sir, I may be a little late to ask this, but it would be kind of for you to answer. Sure. Working in a cybersecurity service in UK, I was just a bit curious. How did you come up with this idea of setting up a venture in a strapping industry? Because it's a little non-core industry, an unconventional business, I would say. I was just a bit curious. Was there any experience in your family related to steel business or something?
See, not really. None of my family members had any experience in this industry. When I was working in the UK in 2017-16, I really wanted to move back to India. So I was analyzing various, business opportunities. That's how, one of my well-wishers gave me this idea. So I was doing a market research about this product also. So purely, logically and financially, when you look at this project, there was a gap in the market. And I was confident that I can able to, address this gap by, putting up a production line. So that's how we started this project.
All the best. That's all.
Yeah.
I don't have any more questions. All the best.
Thank you, Mr. Patel.
Thank you. The next question is from the line of Namish Gupta, an individual investor. Please go ahead.
Sir, it's just a follow-up question. Hello?
Yeah,
sir. It's just a follow-up question. I think I missed some conversation in between, so pardon me for that. Sir, I just want to know regarding our EBITDA margins. So, do we have any cost plus margin kind of contracts with our customers so that, whenever there is a fluctuation in steel prices or something, we can protect our margins, sir?
We have, when in packing contracts in long-term supplies, usually there is a fixed component, raw material plus X rupees, that is the selling price. So that component is agreed during negotiation in packing contracts or in other contracts. I have a 5-year contract with JSW. There, whatever my EBITDA margin is already fixed. Okay, based on monthly price increase and decrease, the selling price will be fluctuating. So, like I said, 50% of my orders are long-term orders, 40-50% of my orders, where the EBITDA margin is already fixed.
Okay. So, sir, whatever the raw material price fluctuates, that we easily pass on to the customer. If it increase, then we charge more. If it decrease, then we reduce our selling price, correct?
Correct. That's absolutely correct.
So, this is in 50% of the contracts you are saying?
Yeah, in 50% of orders, EBITDA margin is fixed. Even in the remaining 50% of regular orders, there are companies, they don't go into contracts, they buy month on month whenever they have a requirement. There, whatever is the spot price, we will pass on to them. Let's say if there is a 3 rupee price increase in May, I will increase my June prices by 3 rupees. All the customers will buy with the current pricing.
Okay. Got sir. Thank you, sir. Thank you.
Thank you. The next question is from the line of Viraj Mahadevia, an individual investor. Please go ahead.
Sorry, sir, no more questions at my end, but at some point it would be great if you can organize maybe a site visit or a visit to your headquarters in Chennai.
We love to have you here. You can, email to my company secretary, cs@krishca.com. We are regularly facilitating visits from investors. So whenever you're available, we can definitely take you here.
Great. Thank you. All the best.
Thank you.
Thank you. Participants, if you wish to ask questions, you may press star and 1. As we have no further questions from the participants, I would now like to hand the conference over to Ms. Kajol Gowda. Over to you, ma'am.
Thanks. Thank you everyone for joining the conference call of Krishca Strapping Solutions Limited. If you have any queries, you can write to us at research@kirinadvisors.com. And once again, thank you everyone for joining the conference.
Thank you. On behalf